Last month, a cluster of wallets holding over 40,000 Bitcoin, roughly $3.8 billion, moved everything onto exchanges within 48 hours. The price fell 19% in 3 days, and the headlines declared Bitcoin was finally finished. But here's the part that doesn't make sense. The exact same week retail traders were panic selling, BlackRock's Bitcoin ETF recorded one of its 3 largest single-day inflows ever. $3.8 billion worth of Bitcoin hit exchanges in a single 48-hour window. On-chain trackers lit up red. The 200-week moving average, the line that has held as bedrock support through every single crash in Bitcoin's history, cracked for the first time since the brutal collapse of 2022. And right on cue, Bitcoin is dead started trending globally. You have seen that hashtag before. You probably rolled your eyes. But this time felt different because the sellers weren't retail panic. Wallets tied to institutional desks, long-term holders sitting on years of profit, some of the most patient money in crypto, all moving at once. So here is the question that should be keeping you up at night. If Bitcoin is genuinely finished, why is the underlying data sending completely contradictory signals? Why are some of the sharpest on-chain analysts calling this the most interesting setup in 3 years? That tension is exactly what this video is about. So why did this all break at the same moment? Because 3 separate pressure points hit the market at the exact same time, and that kind of overlap is not a coincidence. It's a perfect storm. First, the Clarity Act, the bill that was supposed to finally draw clean regulatory lines between securities and commodities, stalled hard in a partisan standoff on Capitol Hill. No clarity means no green light for institutional deployment. Compliance desks at major funds do not move without legal cover, and Congress just yanked that cover away. Second, the Trump crypto bank controversy landed like a grenade inside those same compliance departments. When politics and crypto collide that visibly, risk managers get nervous fast. And then, almost on cue, Jeremy Grantham, one of the most quoted names in legacy finance, called Bitcoin a useless speculative mechanism, and every major financial outlet amplified it within hours. That phrase ran everywhere. This was not organic fear spreading through the market. It was a synchronized narrative event, engineered or not. And once you see it that way, the price action starts to look very different. So does Grantham's actual argument. Now here's where long-term holders actually live and die, the 200-week moving average. For serious Bitcoin investors, this line isn't a suggestion. It's closer to scripture. Every single time Bitcoin has closed beneath it, late 2018, the COVID crash in March 2020, the FTX collapse in November 2022, the market faced one of exactly 2 outcomes. Either a full capitulation bottom or a violent, almost vertical recovery. There is no slow drift sideways. The line forces a decision from the market. So the real question is which outcome we're looking at this time. And that's where on-chain data earns its paycheck. Minor capitulation signals measured by the hash ribbon indicator are flashing amber right now, which historically precedes selling pressure from miners forced to liquidate holdings to cover operating costs. That's meaningful stress. But here's the counterintuitive piece. Exchange reserves are actually falling even as price compresses. Coins are leaving exchanges, not flooding in. That's accumulation behavior, not panic. And the MVRV Z-score, which compares market cap to realized cap, is sitting in territory that, historically, has marked generational buying zones rather than prolonged bear markets. None of that guarantees anything, but the data is telling a more complicated story than the headlines suggest. Now, it would be intellectually lazy to dismiss the bears without taking their best argument seriously. And the most serious bear alive is Jeremy Grantham. This is a man who called the dot-com collapse in 2000 when everyone told him he was wrong, called the 2008 housing implosion when banks were still throwing champagne parties, and flagged the 2021 everything bubble before the Fed even admitted inflation was real. His framework is simple and brutal. Assets with no intrinsic cash flow, no earnings, no yield, are priced on pure sentiment, and sentiment always mean reverts to zero. Applied to Bitcoin, that's not a fringe argument. It's a coherent intellectual position. The uncomfortable problem is this. Grantham has called Bitcoin dead or worthless at least 9 separate times since 2017. Every single one of those calls came at a price Bitcoin later obliterated on the way up. 9 times. And here's the real question. Not whether Grantham is smart, because he clearly is, but whether a valuation model built for equities and real estate actually applies to a fixed supply, decentralized settlement network that no single government or company controls. That distinction matters enormously, and it's exactly where the smart money argument gets genuinely complicated. Here's something most analysts completely miss when they talk about politics and crypto. This isn't about whether you like Trump or hate him. This is about a specific mechanical problem sitting inside every compliance department at every major hedge fund and family office in the world right now. The Clarity Act, the legislation that would finally define whether Bitcoin is a commodity or a security, is stalled. And until it moves, institutional allocators literally cannot touch crypto without exposing their firms to legal liability. Their lawyers will not let them. It doesn't matter what their portfolio managers believe about Bitcoin's upside. Classification risk is a career-ending risk, and that means billions in sidelined capital that wants in but can't get in. Now here's where it gets interesting. Go back through every major regulatory panic since 2017. China's mining ban, the early SEC enforcement wave against exchanges, the 2022 crackdown that ran parallel to the Terra collapse. In every single case, the 12-month forward returns from those fear peaks were extraordinary. Not mediocre, extraordinary. Regulatory uncertainty and price suppression have historically been the exact same event wearing different clothes. The fear is the setup, which raises an uncomfortable question about who actually benefits from that fear lasting longer than it needs to. Here is where the story gets genuinely uncomfortable. While crypto Twitter was flooded with "I sold everything" posts and doomsday threads, on-chain data was telling a completely different story. Long-term holder supply wallets that have not moved a single coin in over a year actually increased during the dip. Let that sink in. The people who have been through multiple cycles, who watched Bitcoin drop 90% in 2018, did not blink. They added. At the same time, spot Bitcoin ETF desks were quietly absorbing enormous amounts of sell pressure. Billions in inflows hit during what most retail traders called a collapse. So what actually happened? Retail panic sold to institutions at a discount. That is the structural truth the noise is designed to drown out. The loudest voices online are often the ones being bought from. This is not a new phenomenon. It happened in 2020. It happened after FTX collapsed, and the pattern keeps repeating because the emotional cycle never changes, only the names do. And understanding that pattern is exactly what separates a reactive trader from someone who actually builds wealth through these cycles. So let's put both sides on the table honestly, with no spin in either direction. The bull case is built on math that hasn't gone away. Post-halving, new Bitcoin issuance just hit its lowest rate in the asset's entire history. Miners are producing roughly 450 coins a day. Spot ETFs on some days are absorbing 10 times that. That supply and demand gap is real, it's measurable, and it hasn't resolved yet. Layer on top of that the growing whispers about sovereign wealth funds quietly doing allocation studies on Bitcoin. Not confirmed. But 3 separate credible sources have floated it in the last 60 days. If even one mid-sized sovereign fund moves, the absorption math shifts violently in the bull's favor. Now the bear case, and this one deserves equal airtime. Rates staying elevated through late 2026 is a serious scenario. Every risk asset gets compressed when capital has a safe alternative yielding 5%. If the Clarity Act stalls in committee, the regulatory vacuum that follows is roughly 12 months of institutional paralysis. and the most dangerous near-term scenario, a cascade of leveraged long liquidations that produces a secondary leg down. That range, $45,000 to $48,000, has real structural support, but getting there would shake out a lot of hands first. Both of these outcomes are live. Neither is a fringe scenario, and knowing that changes how you actually respond to this moment. So what do you actually do if you have $500 in crypto or 50,000? Here is the mental framework that separates people who come out ahead from the ones who don't. Think of your holdings in two buckets. The first is your conviction stack, the portion tied to your long-term thesis, the reason you bought Bitcoin in the first place. That stack does not react to a single week of headlines. You don't touch it. The second is your trade stack, a smaller slice you can move on short-term signals without the emotional bleed contaminating your core position. That separation is everything. Dalbar's behavioral finance research has tracked this for decades, and the conclusion is brutal. Retail investors who panic sell during drawdowns consistently lock in their worst prices, then watch the recovery happen without them, and re-enter higher out of FOMO. It's not an intelligence problem. It's a system problem. When your entire stack is one emotional decision away from a market order, you will make the wrong call at the worst moment. That's not a prediction, it's documented human behavior, and understanding it is how you start to build differently. The next 60 to 90 days are the window that determines how 2026 ends. Three things matter most. First, the Clarity Act. If it clears a Senate vote before September, it rewrites the regulatory landscape overnight. Second, the next Fed meeting. It is not just about the rate decision, it is about the language. One dovish phrase can flip institutional sentiment faster than any chart pattern. Third, watch weekly ETF inflows. $200 million per week is the line. Above it, that is institutions building positions. Below it, that is tourists rotating out. But if you want one single metric to cut through everything else, watch the long-term holder-supply ratio. When it climbs while price falls, the people who have been through every cycle are quietly buying what the panicked hands are selling. History says that is not a warning, that is a signal. This is the analysis that does not exist in mainstream financial media. Subscribe, because the next update could be the most important one yet.